it's important to be not just a saver, but an investor too. The CFA Institute's Bob Stammers is here to explain why. Welcome, Bob.
Hi, thanks for having me.
So Bob, first quickly explain to us, give us the difference between saver and investor.
Okay, well, an investor is someone that saves and then uses that capital to invest to reach their financial goals. So what they're trying to do is they've got capital and then they focus on the return on capital in order to reach their goals. Savers, on the other hand, are people that really primarily are worried about capital preservation. So they're saving, but they're not leveraging that capital in order to achieve their financial goals.
Great explanation. Now, some savers might feel, you know what, like I feel really great about myself that I save a certain percentage of my paycheck. I'm feeling good about that. But you said there's a few risks with that. Remind us of some of those risks.
Well, it really depends on what you're saving for. If you're saving for the long term, let's say you're a retirement saver. It's very unlikely that you're going to be able to reach your retirement goals by just saving alone. So it's important that you have to get some return on your investment. And that means taking risks. And what we find is a lot of savers don't take enough risk in order to reach their financial goals. So because of their focus on capital preservation, sometimes they won't buy financial products, things that have a little bit more risk because they don't like the volatility, but then again, they're not leveraging their assets effectively to reach their goals.
Now, a lot of millennials some of them tend to be more savers than investors, but they have time on their side, so does it really matter for them?
Well, it's interesting because younger people have time on their side so they can take more risk, right? Because they have time over time if there's volatility in the market. But then again, they don't have to take as much risk, right? Because they have time on their side. So if they're young and they're starting early and if they have real fiscal discipline, they can probably get away with being conservative and still reach their goals over time.
So conservative, not just all cash though. We want to be clear about that.
Yeah, it's less risky financial products, still with something that has a return where you can get the effect of compounding over time.
Got you. You said another reason to be an investor rather than just solely a saver is to understand the risks of what you are investing in. So some people may think of themselves as a saver, but they're really an investor if you look at their portfolio. Tell us what you mean by that.
Well, it's very hard to expect people to take on the role of investors if they don't perceive themselves as such, right? There's lots and lots of tools out there. There's lots of education for people to learn more about investing, but it's unlikely they're going to take advantage of that if they don't see themselves as such. This is very typical of homeowners. We see a lot of people buying homes for other reasons than to increase the value of their equity stake. They find it because people want security, they don't want to pay rent, they want to live in a certain part of the world. But then again, they don't see the risks of what can happen, and we've seen that recently with the crisis in the residential home market, where a lot of people lost lots of value. They didn't see it coming, and they didn't have a way to mitigate it. A lot of people had way too much debt on their hands, and so a lot of people lost their homes. This could have been mitigated a bit if people had really been thinking about their home as an asset, as an investment, as opposed to just someplace where they lived.
That's a great point. How can advisors help convince or help teach investors that they are in fact investors and not just savers? Do you have a tip or two for advisors?
Well, I think they need to look at the totality of their assets. We see anecdotally that some advisors don't even look at someone's home, the equity in their home, as part of their portfolio, which I think is a real mistake. But they really need to talk to them about what are their financial goals. How are they going to reach them, and really show them that they're going to need to take some risk to get there. I think most people, once they understand that they're not going to be able to get there, let's say their retirement goal or their kids' education, whatever it may be, by saving alone, then they're more apt to start learning and becoming better consumers of financial products.
Education is powerful. Thanks so much, Bob.
Thank you.